Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Hello, welcome to the Kingdom Finance Show. I'm your host, Chad Frantzen. Thanks so much for being here today. And on today's episode, I'm going to share some musings, thoughts on what's the major difference between the economy and the markets. We had an episode here a week or two ago we entitled The Echo Bubble, talking about asset prices and levels and what's happening there. I want to continue that thought. There's a lot of different market analysts out there that I follow. And one of the things I think is interesting here, we're filming this in the summer, July time period, 2023. So summer doldrums tend to kick in with the markets, and usually economic realities hit in the fall. So I'm going to spend a few minutes today talking about that. Really appreciate you being here on the Kingdom Finance Show. Again, if you want to connect with us, please subscribe, leave us a big thumbs up on the review. You can connect with us on social media, so just look for Chad Frantzen, Wealth Builders Investments, Kingdom Finance Show on all your social media platforms. We'd love to hear from you. Again, the goal of the Kingdom Finance Show is to provide you with wisdom and insight to bring clarity out of economic chaos so that your families, your businesses, your communities, your organizations that you're a part of, that you can make decisions in how you lead, how you manage, how you invest that bring glory to God and that are in line with biblical principles. So very hard to do in today's day and age because everyone is woke and supporting a very socialist, liberal agenda. So it's very hard to run your business, run your family, run your investment dollars and resources with a kingdom perspective without getting intertwined with all the craziness. So that's our hope here. Connect with us online at wealthbuilders.net and shoot us a question, info@wealthbuilders.net, if we can help you in any way, shape, or form. So, let's jump in. Again, just going to spend some time today comparing, contrasting what appears to be a very disjointed market related to the economy. So I'm speaking from my own opinion, just hear what's going on in the U.S. And of course, when I say the word market, I'm generally meaning the broad capital markets, which represent stocks and bonds, interest rates, the major underpinnings of the economy. Will include real estate in that as well, although it operates a little differently depending on if we're talking what type of real estate. But really, the market has been on a tear. It's been up significantly the first half of 2023, and yet all the while, the economic numbers are not good. And so that's why many of you have talked to me personally. I've been of the opinion, again, Chad's opinion here, that I don't want to be too heavy in stocks right now. I mean, I want to pick and choose where I am, but even with the run-up, I'll cover some stats on that. It makes me a little uneasy, having invested through 2000 and 2002 period and then the 2008 bear market as well, and just seeing kind of the euphoria that's once again happening in the stock market. Let's talk a little bit about inflation. Since COVID, politicians have printed almost $6 trillion out of thin air, just created $6 trillion. Boom. Now, since 2020, we've added approximately $8 trillion to the U.S. debt. And this is hands down the largest 3-year debt increase run up in history. Now, free money, as it were, cannot last forever. At some point, reality sets in. I call that financial gravity. And with the national debt The national debt back in 2008 in the United States was $9 trillion. Today, it sits somewhere north of $23 trillion. That's massive, massive, massive. So, again, I want to talk on the economy here, and then I'll pull in the market here at the end, because I think, spoiler alert, I think going into the fall, we're going to have some awakenings with what's going on in the markets, because I don't think we can sustain. I don't think we're at the beginning of a new bull market in the markets. There's really only three ways to pay off this printed money, this $6 trillion, which has, let's face it, that's what's created all the inflation. So whether you're buying Legos, whether you're at a restaurant, a grocery store, anywhere you go as a consumer, it costs a lot more for things, period. And it is a byproduct of $6 trillion being created by the government out of thin air. There is only three ways to pay off unfunded money when you just you print it, as has happened in the last few years. The first one is you raise taxes. So the government can raise taxes. Now, politicians don't want to do that. They don't want to run and be up for re-election, so they're always towing that line on there. Now, there's some liberals who are good raising taxes, but overall, the sentiment in Congress is not that they want to raise taxes. Personally, I think inevitable that we will see an increase in taxes, but that's number one, how that can pay for these unfunded dollars. Number two, the government can cut spending. Now, let me educate you a bit on this. 80% of the budget is made up of, I'm talking about the government budget, is made up of Social Security, Medicare, and defense. And so, even with this latest Biden-McCarthy debt ceiling, let's agree to work together. When you flat look at it, there's really nothing in there. It's more of a shell game between Biden and McCarthy, and that's why some people did not support it in Congress. It actually doesn't help with taxes once you get into 2025 and beyond. So number two is you can cut spending. Fat chance. Everyone likes their entitlement programs for their precincts in the spending. Number three, the government can deflate and devalue the U.S. currency. And that's really what's been happening. So it's not so much that the U.S. dollar is going away. I don't actually hold that view. A lot of people feel that, the U.S. dollar is no longer going to be the default currency for the world because it's been going down. Well, hello. How else are we going to address these trillions of dollars? Raise taxes, cut our spending, or devalue the U.S. currency. And that's really what the government has chose to do. Option number three. Since the money supply, that's $6 trillion, that's the money supply, since that was increased by some 26, 27%, that means that the U.S. dollar has to be devalued to offset that. So again, a lot of economic underpinnings, if you will. We look at inflation; it's still high. The inflation rate for all of 2022 was somewhere around 6.5%. Right now, we all recognize as consumers and families and business owners that some things are much higher than that. Bottom line here is inflation is going nowhere. It is going to be here, in my opinion. 4 to 5% inflation is the new norm. It's not going to get down anytime soon to 2.5, the way the Federal Reserve Board wants it. And so, what does that mean? So, a lot of the market has been running up, and in fact, as we shared in one of our other episodes, the first half of 2023 was one of the best half years for the NASDAQ. Significant gains. Now, how many of us think that the economy is really strong? Now, the jobs market has proven to be extremely resilient, and I've encouraged viewers and listeners to look at what the jobs market is doing, and that is the key that the Federal Reserve is looking at. So we just had some numbers come out here recently for June, and the jobs market is still very strong. Now, what that means is that as long as the jobs market is staying strong, inflation staying high, the Federal Reserve will still have to raise interest rates. Now, they did pause, as we talked about. They're taking a break, thank God, from raising rates, but they have already communicated publicly that they are planning to raise rates 1 to 2 more times. And by and large, for us everyday consumers, it's because inflation is still stubborn and the jobs market is still very strong. So they're trying to cool things down and get inflation down, but it's not working as fast as they would like it to from that regard. Now, let's talk a little bit about the stock market. I mean, here, the first half of 2023, just 5 stocks within the S&P 500, Facebook, Microsoft, NVIDIA, Apple, Tesla, just those 5 companies out of the S&P 500 through the first half of 2023 were up over 80%. Now, most of the stock market is not up. I mean, there's certain companies, but it's very concentrated in these high growth, high tech, monopolistic type companies, right? I mean, if you took Google and Amazon out of the S&P 500, it's almost flat for the year in 2023, right? So the market, it doesn't give us a clear picture because a lot of institutions and investors are just piling into some of these common names, the ones I've mentioned, and it's not representative of what's really going on in the economy. So for those of you who listen, who are business owners, franchise owners, I don't have to tell you this twice. You see this, you're running your books, your orders, and you can see that for it. So really, we have in the markets, we have these handful of huge monopolies, these monopolistic companies. We look at Amazon and Apple and just the huge footprint they have, Google, and the amount of footprint they have on global search traffic, Meta, Facebook as well. And what about the banks? JP Morgan now controls over 15% of all U.S. banking deposits. JP Morgan, over 15%. So I've encouraged viewers, my personal opinion and what we do at Wealth Builders Investments is I don't want to work with the big banks. They have a very woke, liberal agenda that they support. And if I'm a consumer or doing business banking, I would much rather work with local and regional banks and credit unions that I can understand, that I can go in and talk to, and that are going to share my personal values and Christian worldview. So we have these handful of companies on the tech side, and then JP Morgan in the banking side, and that's a lot of what's driving the market. The economy statistically is signaling recession, but the market is people are piling into these names. Artificial intelligence has been a huge run up in the second quarter. And so for some of you investing in your 401k or retirement accounts and you're in an index fund, you're going to have positive returns, right? Now, my point is, one, I don't want to be investing as much as I can help it into companies that are following a woke agenda. I'd rather have companies that are what I call pro values and that have really strong business models. And there are those out there. There's probably 40 to 50 companies that we follow with our portfolios that very much have strong market share in their industries. They have strong Christian CEOs, men and women running the company. They have programs in place to take care of their employees and their community, and they're not jumping on the liberal woke bandwagon. And they have really good return, what we call return on equity for their shareholders. So you can have both. Again, the markets, I'm talking just at a high level, it's really been these big tech companies that have been the majority of the return so far in 2023. So what does that all mean, Chad? You may be asking. Well, I think it's pretty clear to me that the economic data is all pointing to a recession, starting in the next 2 quarters. Generally, there's more volatility in the news cycle with the markets in September and October. We're in the summer doldrums. We're recording this in July, so July and August are pretty chill. A lot of people on Wall Street and big hedge funds, they're out for the summer or they're working less hours. So there's lower volume, lower speculation in what's driving the markets on that. There is what's called a leading economic indicator index, or LEI, leading economic index. And it's been around for a long time. And it takes just, again, if you think of driving a vehicle and looking out the front windshield where you're going, or looking in your rear view or side view mirrors, there are leading indicators and there are lagging indicators. Inflation, as much as we talk about it, is a lagging indicator. It is a rear view indicator. Okay? Doesn't mean it's not important. However, if I'm driving, whether it's on a small side street or on a major freeway or interstate, the action is out the front windshield. I still need to look in my rear view and side view mirrors to be a safe driver, right? We're using this as an analogy for being a wise kingdom investor. But out the front windshield is what we call these leading economic indicators. And these have been around for a long time, but there's several on there, and all of them, looking at my list here, the leading economic indicators for June of 2023, all of them, and there's like a dozen of them, are signaling recession. And in effect, these indicators can either be declining, they can be plateauing, or they can be increasing, growing, right? So up, down, or sideways. And all of these, I'm not going to go into each one of these on today's show, but you can go research this. I mean, it's things like consumer goods, new orders, or construction materials, or U.S. building permits, manufacturing orders, like things that run the economy, right? So all of these are in declining, which signals a recession. And so that's really your front windshield things you want to be aware of. Now, on the surface, it looks like, and there are some people in the market saying, hey, we're in a new bull market. It's going to be a soft landing. Everything's in the all clear. I don't personally hold that view. Now, that's my opinion. I do think as we get into the fall and as we see the Federal Reserve comment on interest rates particularly in September, that we're going to see increased volatility in the markets. And by the markets, I'm saying the stock market, the bond market, interest rates, that whole underpinning for the U.S. economy. Now, let me speak a little bit to the recession. A recession is not a bad thing. It's only bad if you're not prepared for it. It is the life cycle of the economy. Things need to get cleaned out so new things can grow, right? Just like a forest. Historically, the stock market bottoms. The stock market will find its capitulation. It'll find its bottoming value range, its floor, before the recession ends, right? So in the 2008, 2009 bear market, that was early March of 2009, and the recession was not quite done. It was 2/3 over or thereabouts, but the market bottomed before that. So the markets are a predictive indicator. But some people are of the opinion that it's predicting a new robust economy and new bull market, and I don't see that. Now, recessions generally last 9 to 18 months. That's a pretty broad range, but somewhere in there, depending on the severity of it. So we know companies will be off with their earnings and with their revenues from that standpoint. Now, the S&P 500 is really not that far off from its all-time high here in the summer. It's just continued to, I've called it an echo bubble, but it's just continued to creep back up, primarily driven by the handful of tech companies that heavily represent the index. Really, there's about 5 to 6 companies that are driving almost all the returns for that. So the S&P 500 is only now this percentage changed from day to day, but it's only about 11 or 12% below its all-time high. So think about that. In the U.S., if the stock market, it's all-time high, and we're sitting here today with everything going on with inflation and really high interest rates and high mortgage rates and some uncertainty on the political front, oil prices, and in the market's only about 11, 12% below its all-time high. So that's significant to me. So what that tells me, again, my personal opinion, again, we're talking here about how to be good kingdom finance investors, is that there's more downside potential right now than there is upside potential. So again, you always want to wager, think through, make a decision on downside risk versus upside potential, right? So if there's more upside potential in an investment, whether this is through your personal business or whether this is through your retirement account, you want the upside to outweigh the downside. So I think right now, I think we're going to see increase in volatility coming into the fall, and the markets are 11, 12% from their all-time highs. To me, that makes me think there's a lot further this could fall, and I think realistically, in the recession as it starts, the markets will fall 20 to 25%. So if you're looking at the S&P 500, again, my opinion, if you're looking at a chart on that, you could see the S&P 500 drop back down to 3,500, 3,600, and even potentially a little lower than that from where it is. Bottom line is the economy and all the data points, right? The windshield gauges are all pointing to recession starting this fall. Now, the media will most likely pick up on that, and we will already be in recession. So that's why I encourage people, start getting prepared now. Start thinking through with your businesses, with your personal investing, with the things you're involved in that you have leadership over, of how to prepare for that, because there will be a lot of meaningful opportunities if you know what to look for. And I think I really want to impress that upon us just as we kind of wrap up today's show. Again, the economy is saying one thing, the markets are saying another thing. Now, if you're just watching CNBC or you're listening to Jim Cramer or whatever you're watching, everyone's saying, "Hey, this is great. It's a soft landing. It's a bull market. Let's start getting back in heavy on stocks." Now, we invest in stocks. I just don't personally feel that you want to be overweighted in those right now with what the economy is saying. Now, everyone has to do their own research. Again, I'm not giving investment advice. I'm sharing my personal opinions about this today. But I do think to be a wise steward, we want to understand two things. One, is our money working alongside companies, organizations that do not support our Christian values? Yes or no? Okay. Second question is, are my resources, whether they're investment dollars or what I'm doing through my business as a business owner, entrepreneur, franchisee, are those resources properly allocated, properly distributed to the parts of my business, the parts of my investment portfolio that will most benefit, be the most stable, be the most have the greatest potential for upside in the current economic environment, right? So are my resources positioned properly? That's really the two questions. So again, we could boil that all down. I can bore you with all the stats on the markets and the leading economic indicators. We know the government, in summary, with this printing of $6 trillion, it's the direct reason why we have such high inflation. So as investors, as business owners, we have to think through, okay, so how does this shake out? Well, they're going to devalue the dollar some. I do expect taxes to go up. Again, we're going to be heading into a presidential election year in 2024. So no one's going to be running on I'm going to raise taxes platform on that. And the markets tend to run up ahead of things. Now, they also, in summary, do tend to bottom before a recession ends. So the expectation, if looking at history, is that the markets, once the recession is finally here, and I think parts of the economy are already in a recession, but once we get into the fall and if rates keep going up, then the markets are going to have a correction. And it could be, meaningful, more than a 10% correction in the markets. And for those that aren't prepared, that are heavily concentrated, that can be very painful. Again, everyone's in different parts and stages of their life and with managing of resources. But the more you can be diversified in managing the resources of your company or your investment portfolio, that way you're ready for when these types of things happen. I don't personally think you should go put all your money in gold and silver. I invest in it, but I don't think it's like the one answer for everything. You want to be like Solomon, who said in Ecclesiastes, you want to invest in 7 or 8 different things, for you know not what will come upon the land. So that was the richest man of all time, richer than the 5 wealthiest people in the world today in 2023. So that needs to be our mindset of how we're managing and stewarding resources through our business, through our ministries, through our retirement accounts, through the different assets that are available in the capital markets. So I hope that's been helpful. Again, you want to be thinking through with your team of counselors, with your family, with your business partners. Okay, one, is what I'm doing, are we supporting companies that do not line up with our Christian worldview and the teachings of Christ? Number one. Number two is, are our resources within our company, within our investment portfolio, are they properly diversified based on what's happening in the economy and what the market is saying versus what the economy has been telling us for some time? So again, if you want to learn personally how to apply this to your business, your ministry, to your investments, we'd love to connect with you. Best way to reach out to us is go to wealthbuilders.net/invest. wealthbuilders.net/invest. Connect with us there. We've got a free download report we'll send out to you. And then again, find us on social media. Look us up. We're on all the outlets: Chad Frantzen, Kingdom Finance Show, Wealth Builders Investments. Hey, I'm really glad you're here. Again, the market versus the economy. Who's telling the truth here? They've been running on these different tracks all year. I do want to just, in summary here, give a word of caution as we enjoy the rest of our summer and head into the fall, that I don't think the markets are indicating what's truly going to be happening in the fall and as we head into the first of 2024 and what will be a major election year. So let's keep an eye on things. Again, be wise, be disciplined, and encourage you to invest and manage based on your Christian values and a kingdom perspective. Hey, thanks for being here on the Kingdom Finance Show. Chad Frantzen, I appreciate you, and we will see you next time. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.